Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So in this video we're going to cover what is earnings per share, and then we'll give a practical example so we can go on a website and have a look at it, figure out how it's calculated and why it's useful to investors as well. As usual, I always try and give practical examples when I'm doing this kind of thing. So we'll show the picture on Yahoo Finance, and then we'll also go to the actual income statement and look at an example of Apple as well, just so you can see where the numbers are derived from. So earnings per share is made up of a few different elements. So obviously the first element is the earnings. So the earnings is actually the profitability of the company. You might see that called net income, net earnings, net profit. All those things are used to describe the actual profitability of the company. So the earnings are found on the income statement of a business, which is normally filed on a form called a 10K, which is used by the Securities Exchange Commission, which is actually like a legal filing that's required in the United States. So now I'll put an example on the screen showing how the earnings per share is calculated. So we take the net income minus the preferred stock dividends, and then we divide that by the number of shares outstanding, or the average weighted number of shares outstanding. And then this will give us the price on a per share basis. So let's have a look at an example from Apple. Here we can see the consolidated statement. So this is their income statement. So here we've got the top line. So this is the revenue. So you can see here that's 274. Which is billions. And then going down, we've got the cost of sales. So the cost of sales is the 169,559. So that if you minus that from the 274, then you get to the gross profit. So you can see the gross profit here is 104,956. So from there, we remove the operating expenses. So if you remove the 38,668 from that figure, then we get to the operating income. So there's other income that kind of gets added to that, which is the 803. And then that gives us the income before taxes. Once you've taken the tax provision off, you end up with the $57 billion. So now once we've got the net income, we can then also use the number of shares outstanding to calculate the earnings per share, 57 billion, and then we divide that by the 17,352,000, which is the basic number of shares outstanding, and we get 3.31, so that's $3.31 there. And now let's also look at the diluted as well. I'll go on to diluted in the next slide, but you will notice that the number of shares is higher. So obviously this has the effect of reducing the earnings per share to 328. So now let's go and look at the earnings per share calculation for the diluted EPS. So we have the net income minus the preferred stock dividends. So Apple doesn't actually have preferred stock dividends, they just have common stock. So from this one, we're just taking the net income and then we're dividing that by the outstanding shares plus the diluted shares. So the diluted shares usually come from stock options or stock warrants. So in simple terms, these are basically transactions where a person or company can pay for the right to buy the stock at a later date for a specified price. So not all stock options will be exercised, but it's kind of a useful metric because it shows the total amount of shares if all of those options are exercised. So it's a kind of worst case scenario, and then gives us a more conservative number, which is usually preferred by investors. So here we can look on Yahoo Finance and see that they're showing the earnings per share TTM. TTM is trailing 12 months, and that's 3.28, as we just saw on the report from Apple, which is on their investor relations site. So it's also important that we can understand what can affect the earnings per share. So if we think about this logically, obviously the earnings is the profit. So what are the things that can affect the profit? So obviously one way to increase your profit is to increase your sales or increase your revenues. In that way, obviously, if you're increasing those and you can keep your costs the same, then your earnings will increase or your profit will increase. And the second one is obviously you can keep all your earnings the same, but then you can reduce some of your expenses. So if you're reducing the expenses and keeping your revenues or your sales the same, then obviously that also represents increasing profitability as well. Obviously, what you're looking for in a company, you actually want to see them grow the sales and also reduce the expenses where possible as well. Now, if you find that, then you've got a really good company, because they might be able to take advantages of economies of scale as they kind of build their product out. They might be able to increase the sales or the revenue or the top line, as you'll see it called, and then also manage to make cost savings on the bottom line. So then you're seeing a company that's really profitable, particularly as you see that growing over time. So another thing you want to watch out for here is if the company is doing buybacks. If the company is buying back their own stock, this will have the effect of reducing the number of shares. So if you're reducing the number of shares, obviously then your earnings per share will go up because the number of shares has gone down. Now, you'll find quite a lot of companies these days doing share buybacks, and that's kind of almost would be a separate topic on its own to cover. But for this purpose, you just need to know that share buybacks aren't necessarily a bad thing. They return value to investors as long as the company can't find any better way of spending the money. They can't spend it on growing the company further, so they decide to purchase their stock back. So this has the effect of returning value to the investors. So because now they're kind of getting a bigger piece of a smaller pie, so it kind of makes their value go up. And this is also the same as what happens with their earnings per share. And obviously on the flip side of that, if they're issuing more stock, then that means there's more stock in the market, so it kind of dilutes the shares. So that means that the earnings per share is going to go down because it's been diluted by the fact that there's more shares available in the market. So earnings per share is a measure of profit, and obviously what investors want to see is profitability growing over time. So it's kind of good to look at the earnings per share, say over the last 10 years, and then you compare the average that the earnings per share has increased or decreased over a 10-year period. Then you could also look at it from a 5-year period, a 3-year period in the last year. So it kind of gives you a good base to understand, is the company becoming more or less profitable? Obviously, like the caveat we mentioned, you kind of need to keep an eye on how many stocks are being bought back as well, because this will have the effect of obviously inflating the earnings per share. And that's why it's a good idea not to use this as a metric on its own. You want to kind of use this along with other metrics such as free cash flow, the sales, and the book value, because that way you get a kind of broader idea of different metrics, and you're not kind of looking at one. You're not looking at one because sometimes companies can manipulate one of the numbers, but it's difficult for them to manipulate 4 or 5 different metrics. So if you enjoyed this Invest in Terms video and like to see more kind of similar videos to this, I was planning on making it into kind of a mini series with Invest in Terms and kind of adding in anything that people don't understand or would find useful as well, just to kind of demystify or kind of get rid of some of the jargon around everything as well. So if you enjoyed the content, please hit like and also consider subscribing to the channel so you can get notifications of when I release new videos. Thanks for watching, and I'll see you in the next one. Cheers.